I'm Crystal Futrell, and I'm here with Tim Stats. He's Vice President of Commodities at Schneider Electric. And Tim just wrapped up his presentation at our 49th annual Sosland Purchasing Seminar. And Tim, you talked about energy, which is always an interesting topic, but it's really hot these days. So in a couple of sentences, would you mind summarizing kind of what you shared with us?
Yeah, so I think basically the Strait of Hormuz is the topic.
Yeah.
And I heard it several times when I was there listening to other presentations today and yesterday. And it's the big topic in energy, and it dominates everything on the oil side and the LNG side. Yeah. Strait of Hormuz is the thing. But in the U.S., we're largely insulated from that issue. And so the big things that we have to think about in the U.S. is, can shale gas keep up with all the new demands we're seeing for gas, for LNG, and for creating new power generation to help support the data center demands and the different things happening there.
Okay. Now, some folks may know, or they may not know, U.S. is the #1 crude oil producer in the world.
Correct.
If the Strait of Hormuz does not open, can we manage that okay? Can we fill in the gap of what's not coming out?
We absolutely cannot. Not even close. So that would be a 50% increase minimum to our production levels that are already at level. We're the highest in the world. We're at 13 million barrels per day, roughly.
Yeah.
That would be a significant increase that we couldn't sustain. We wouldn't have the equipment. We wouldn't have the people. We wouldn't have the infrastructure built out for that. It would take years to get there. Because if we could get there, we probably would be there, because we're very much a production-only country. We're not part of OPEC. We don't have any incentives to hold back production. We produce everything we can. So if we could do it, we'd probably already be there, and we're not there.
And we use a lot, don't we?
And we use a lot.
Yeah.
In fact, we use more than we produce.
Wow. Okay. So that kind of puts that in a point on,
That's
on
right.
that. Yeah.
Yes.
And then data centers. So there's a lot of noise about what's good, what's bad. You kind of encapsulated it real succinctly, the pros and cons. Would you mind sharing that with us?
Yeah, so the cons are everything you read about every day. The water, the power. Are we going to have to, as ratepayers, pay for all the new facilities you're going to have to build to generate power? Are we going to be the ones who have to pay for that? All the issues around noise and everything that goes with it. But the pros are actually really simple. There's a lot of tax revenue to be made from data centers with very few people coming along with it, which means all that profit doesn't have to go to build schools and build roads and build infrastructure and create neighborhoods. It just comes. It's just money that comes in, and you do what you want with it. That's a very attractive thing for a government. And these are, you're talking city, county, these are local governments looking at significant revenue changes. So it's a very, very attractive proposition, and that's what creates such a battle. And on top of that, AI's here to stay.
Right.
We all know it. And because it's here to stay, data centers are coming. So if you say, we're going to give up this data center, someone else is going to build it. So it really makes it difficult to just give it all away for nothing. And so that battle will always be there, and we're going to hear about these battles for years to come.
Okay, and then I do want to wrap up and end with going back to the Strait of Hormuz. If we're looking at a long-term closure, what does that mean for gas prices?
I think it's very problematic because today at $4 roughly to $5 a gallon, depending on where you live, the U.S. isn't seeing much of a demand shift. We're just putting gas in the tank. We might be saying, man, this stinks. But we're putting gas in the tank, and we're going to the next place.
Right.
We have 5 million to 7 million barrels per day that's come out of the market that we haven't accounted for yet because we're pulling it out of storage facilities.
Yes.
And because of that, at some point, we can't do that anymore.
Right.
And we've got to lose that demand. And we know the price we're at now is not able to do it. Prices have to go up quite significantly. I would argue they've got to go up to 150 minimum.
Per barrel.
To even minimum start impacting us. I fully expect if it doesn't open, we'll see $6 gas. And that's in areas like where I am in Louisville and areas like here. I'm not even talking California and places where gas prices can already be much higher.
Right.
That will have a very material impact on how we travel locally. It will have an impact on how we vacation, drive, and how we fly. And we haven't seen much of that yet. So I think it's going to take it's going to create a big price hike to remove the demand that has to be removed for the market to be balanced.
Okay. All right. Well, we'll see what happens.
All right.
All right. Thanks so much.
Thank you.